Over the past decade, US states have increasingly taken climate action into their own hands, designing carbon pricing, cap and trade, and clean fuel programs. But those efforts now face renewed pushback from Washington, where the Trump administration has ordered reviews and legal challenges against state-led climate measures. To unpack what's at stake, we're joined by StoneX Global Head of Carbon Markets, Alfredo Nicastro. Thank you for joining us, Alfredo.
My pleasure, Fiona. Nice talking to you.
So let's start with the big picture, Alfredo. Why are US states taking the lead on carbon policy?
Well, this is really not a new phenomenon. When the U.S. decided not to ratify the Kyoto Protocol back in the early 2000s, several states stepped up to fill the federal void. Right, without a federal carbon framework, they formed local markets and regional alliances to create market-based systems that mirrored international approaches. That early momentum built the foundation for today's cap and trade and the new cap and invest programs, showing that U.S. states have long served as policy laboratories when federal action stalls. So it really comes down to policy gap and economic opportunity. In the absence of a national carbon price, many states have stepped in, as we said, not just to manage the emissions, but to stay competitive and attract investment. Also, another important point is that states realize that regional corporations such as RGGI in the Northeast and Western Climate Initiative in the West can deliver efficiency by tapping into larger markets, consistent rules, and better price signals to business. And these programs are not only environmental tools; they also help finance a real financial mechanism for innovation, for energy transition, and long-term risk management. So again, not just about climate, but it's about economic modernization, resilience, and fiscal responsibility.
Can you walk us through the main state or regional carbon programs operating today? You could maybe start with the RGGI that you just mentioned.
Absolutely. There are uh, three major programs that really define the U.S. carbon market landscape, right? Uh, to that respect, and actually to follow a certain chronology, the first one was RGGI, the Regional Greenhouse Gas Initiative in the Northeast and Mid Atlantic. It's the first mandatory carbon markets in the US, and it was launched back in 2009, if I'm not wrong. And it focused primarily on the power sector. It has reduced emissions by about half and generated billions in proceeds that funded clean energy and efficiency investments, right? Then you have the California Cap and Trade Program. It was established back in 2006 through the AB 32, with its first compliance period beginning in 2013. And now it has recently extended until 2045 under the new Cap and Invest framework. It covers roughly 85% of the state's emissions, and it's part of the Western Climate Initiative, where it links even with the Quebec's Canadian system. That shows that a carbon market can actually operate very successfully across borders. So it's something that I think that properly implemented can benefit not only the states, the country, and other neighbor countries. And most recently, we have the Washington State Cap and Invest program was launched back in 23, which adds a new layer of momentum out there in the West, right? And to me, what's really remarkable is that this progress has happened without the federal framework. So state-led programs have already achieved a great deal in the country, and the growing coordination between them signals that U.S. Carbon markets are becoming increasingly integrated and sophisticated.
And how is the Trump administration responding to these state initiatives?
Oh, that's quite an interesting question, right? The new administration has taken a more aggressive stance, I would say, toward state climate programs. It has directed both federal agencies and the Justice Department to reveal and challenge eventually rules that they believe interfere with national energy policy. From Washington's perspective, these programs can look like constraints on energy independence or examples of state overreach. But from the state side, from the state's perspective, they're viewed as practical tools, ways to future-proof local economies, right, and attract clean tech investment and manage climate-related financial risk. So what we're really seeing is a clash between two frameworks: one that is short-term and energy-focused, and another that is long-term and economically strategic to provide sustainable finance to the transition to a low-carbon economy.
And what happens when federal and state policies collide, and who ultimately holds the power?
Another difficult question, right? It's a legal gray zone, I would say. The states actually have the authority to regulate emissions within their borders, but they can make foreign policy, for example, or enter treaties, and that's where the tension arises, especially when programs like California program, the cap and trade in California, expands international. As we know, they connected to Quebec and Mexico, and now they're expanding into some other Latin American countries. So basically, to navigate this, states often form regional blocs like the RGGI or the Western Climate Initiative, which strengthen their legal standing and bargaining power. Um, Anyway, we're seeing several lawsuits testing these boundaries now, and the outcomes will define how far the states can go in building core broader carbon markets. But what is clear, I think, is that states are not waiting; they're adapting within the law, working collaborative, and continuing to move forward.
And looking ahead, what's the likely future of US carbon markets under this political divide?
Well, I'd say that in the short term, the political division certainly create uncertainty for market participants, right? Especially around linkage and regulatory stability. Um, but in the long-term momentum is actually unmistakable. States remain committed. The companies, the corporates are integrating carbon costs into their planning and risk management, and investors are increasingly demanding credible market signals. So uh, it's confirmed actually, but we're seeing a greater uh, interoperability between the state systems and international markets. We're seeing that happening with Canada and the Latin American programs, quite aggressive. So while federal policy cycles may change, it may affect how the markets play, the direction that the market is taking is quite clear. Carbon pricing is becoming embedded into economic strategy. This is not a political debate, I would say. It's a real fact.
And what are the high level impacts of the current administration's policies in global carbon markets and climate action?
I'm not really concerned or seeing significant impact on carbon markets, but there's definitely some implications into the climate action, right? So at the global level, if we think about it, the policy, U.S. federal policy still matters as it shapes sentiment and coordination and affects investment flows. Typically, countries tend to follow where countries, leading countries like US are doing. So it's a bad signal. It's a wrong message to the markets, to global markets, if US is not taking a more proactive approach. Um, but in the short term, a more cautious and adversarial stance from Washington can actually slow international cooperation and create uncertainty for global markets in a timing that is not really appropriate. We uh, Voluntary markets are very illiquid. There's a lot of regulatory dynamics throughout the world that continue to fragment the markets and complicate risk management. So that's not a good thing at the present. But at the domestic level, it can also influence the direction of investment, right? Often favoring fossil-based power generation over low carbon alternatives. So that said, politics aside, global carbon markets have become far more resilient, not depending necessarily on the US. the EU, Canada, and major Asian and Latin economies are pressing ahead, expanding and linking their carbon pricing systems. Multinational companies are adopting internal carbon prices and aligning with global disclosure frameworks, regardless of US politics. Another key global development is the rise of a carbon border adjustment mechanism, like the CBAM in Europe, and in sector specific regulations, which are reshaping trading in high emission industries, such as metal, cement, fertilizers, shipping, and aviation, for example. These measures are embedding carbon costs into global commerce, so impacting international trade. So, in summary, while US policy shifts may create short term friction, they don't really derail the bigger picture, I think. The market forces, investor expectations, and trade standards are now driving climate action forward. And in that sense, the long term trajectory, I think, is toward greater integration, transparency, and accountability. So that momentum remains intact, I think.
Well, thank you very much for your insights, and Alfredo. It's a pleasure catching up with you again.
No, thanks, John. I appreciate it. It's an important topic, and I'm glad to be able to talk about it.
For more videos like this, please do like and subscribe.